Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about a specific investment option that has the potential to reduce overall risk in your portfolio and potentially enhance long-term performance as well. And that category is referred to as liquid alternative investments. So we're going to give you a quick introduction to the category, and then in future installments we'll unpack it in far more detail. Anyway, you'll enjoy this particular video installment. Now, if you are new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement, not just the investment planning area, but coordinating your income and developing a retirement plan. So we've had over 3 decades of helping families navigate the retirement transition. So make sure you hit the subscribe button if you don't want to miss content. Okay, let's unpack liquid alternative investments. Now, before we get into the topic of liquid alternatives specifically, there's a few basic areas we have to cover off first so you have the right context for this investment option. So the first thing we'll talk about is the difference between a strategic approach to investing and a tactical approach. So these are not mutually exclusive and they often will overlap, but it's important that we understand these two ideas so we can see where liquid alternative investments can fit into your portfolio. So a strategic is a very good long-term proven approach to investing. Essentially what portfolio managers do is they take a look at the return and risk characteristics of cash investments, fixed income holdings, between corporate debt and government debt and various debt instruments, different kinds of stocks, real estate would be examples. And they can go back and model the individual return characteristics of each asset class and their risk profile. And then they build computer models to look at how those different asset classes interact with one another as a way of trying to drive a certain return at a certain level of risk. And along the way, the portfolios get rebalanced to maintain the integrity of the original mixes put in place. So it's a very patient, long-term approach to investing, and it's a very common approach in the industry. So it's based on this idea that you can't really time short-term swings and that you need to sort of play the long game in terms of portfolio management. The other approach is tactical. Now, tactical is exactly what it implies. It means that money managers or asset managers are trying to exploit maybe opportunities that they see in the market. So as they look at the economy, they look at tax changes, they look at capital flows between different geographic regions. There's all kinds of factors they look at, and they might build within their portfolios a tactical approach that they want to exploit in the short term to try to accentuate return or actually reduce risk on the portfolios. It's more of a short-term approach to what they see as things happening within the economy or capital markets that they want to take advantage of or seize upon. So many asset management services will use both. Some might use one area primarily over the other, and the liquid alternative investment category does make use of quite a few tactical strategies as a way of exploiting opportunities in the market. So that's the first thing we want to make sure we cover off. So the next thing we need to talk about is just the different asset classes that can be used for portfolios, and then it'll give you a context as to where liquid alternative investments fit in that category. So typically when you're building a portfolio, you're going to think about different asset classes to mix together to build the mix. And the reason we mix classes often is we're trying to get an optimized return and risk profile from the portfolio. So we all know that if you take on more financial risks, you're going to obviously be exposed to more volatility in the portfolio. If you take on less risk, there'll be less volatility. So the main investment categories we can think of would be cash, like government T-bills, high-yield savings accounts, GICs. We have bonds, could be corporate debt and government debt, and there's all kinds of different bond categories we can invest in. Of course, stocks, and within the stock category, you've got big cap, mid cap, small cap. You've got all kinds of investment categories, and then geographic areas, sectors in the economy. You've got real estate, commercial real estate sector, and then you've got a category called infrastructure. And liquid alternatives kind of fit into that category. Infrastructure investments are investments that tend to be non-correlated with traditional financial assets. You think about, bridges and toll highways and hospitals and airports and various long-term infrastructure projects that can provide very good income, maybe the potential for price appreciation, but they're the kind of asset that would correlate differently from traditional assets. Now, the problem with infrastructure projects is that often they're illiquid. In other words, for many retail investors, they can't afford to lock away their money for the next 30 years like a pension plan can to get those kinds of yields. So the liquid alternative space is kind of falls into this space in and around infrastructure. So it has a way of being non-correlated with traditional assets to introduce more diversification into your portfolio. Now, why do we worry about that? Because risk denotes volatility. And so we're often in a situation where we're trying to drive higher returns. So for many retirees, if risk-free investments are paying 1 or 2%, that's not a very satisfying return. And that really limits the potential income and draws you can take from a portfolio. So a lot of retirees are taking on more risk. But with risk comes fluctuation and volatility. It doesn't necessarily mean loss of capital unless you cash out your chips at the bottom of the market, but it does mean fluctuation. If you've got quality assets, they will come back. Now, if you look at this little chart here, the black is basically year-by-year volatility. So every year is going to be a unique return experience, and we can see some negative years along the way. And over time, even though there's year-by-year fluctuation, we're assuming that our portfolio will go up over time, and there'll be a consistent upward trajectory. Not in a straight line, but over time we'll see that compounding value. And we've done lots of videos and had previous discussions on the growth potential within stocks particularly. And then when we look at increasing risk, we do look at increasing the potential for return, but we have to go through this volatility. And that's the whole idea of building portfolios where we're trying to smooth out the pattern of return. And there's a couple of main reasons we want to do that. Let's look at that right now. So one of the concepts in the investment business is a concept referred to as cross-correlation or negative correlation. The basic idea of cross-correlation is to try to smooth out the pattern of return. We're trying to reduce risk while at the same time trying to achieve those long-term returns that we're shooting for. So portfolio managers and asset managers have developed models that integrate a mix of investments to hit a goal return. Now, it's really important that we have a discussion on goal returns. Goal returns are what do you need to get in your portfolio to achieve your specific retirement goals, as an example. That's the only return that really matters at the end of the day. And can we design then a portfolio that for the least amount of risk has a high probability of driving that return? As we need more return, that risk level goes up. And that's why smoothing out the pattern return is so important, because if people get too much risk and they fall outside their comfort level and it's a surprise to them, then there's a very high probability that the investor is going to bail on the strategy when things get difficult in the market. Hence, cross-correlation is really important. So we have portfolio A, or investment A, which is this black, has a pattern of correlation and return. And we have portfolio B, which has a negative correlation to the black line, tends to fluctuate in different directions. And then we have portfolio C that has a different pattern as well. Over the last several years, there's been this phenomenon where you're seeing the bond market tending not to be negatively correlated with the stock market as much as it's been historically. And so we're seeing investors look at other assets that might have this negative correlation, and that's where liquid alternatives come into the mix. They're a great tool to feather into your portfolio to get more of this negative correlation. So again, the idea is not to reduce returns per se. The idea is to reduce risk and to get a portfolio designed so that it has a high probability of achieving your goal return for the least amount of risk possible. Okay, let's start unpacking liquid alternative investments in a little more detail. So again, this is an introductory video on the topic. We'll be releasing future content that unpacks this in more detail, but we'll also include some links to some videos that you can take a look at that reviews this topic area as well. So I'm going to refer you to this particular slide, and we're looking at investment parameters here, and I'm going to compare it to mutual funds, liquid alternatives, and hedge funds. So the one thing that all these investment options have in common is they fit into an investment category called active management. So on the extreme end, you've got investors that might buy some individual stocks and just hold them passively, and there's no active management, very little trading. You might have an exchange traded fund that just buys a basket of stocks in the broad index or a specific sector within the stock market. And again, there's not a lot of active intervention or tactical planning or active management. Those are very low cost investment options because there's no active overlay. With these investment options, they do tend to be a little more expensive, and I'm not going to talk about that in detail today, but obviously if you talk to your advisor or reach out to them, they'll give you more information. But the reason that they're more expensive is they're doing this overlay that's much more interventionist and much more tactical. And so mutual funds, they have management fees, liquid alternatives do as well, and then you have hedge funds. Now, a good way of comparing liquid alternatives to other investment categories, hedge funds would be a good example. Now, hedge funds have no restrictions imposed by Canadian securities laws. And often when we talk about hedge funds, people get a little bit squeamish because they think of Bernie Madoff, right? There's a lot of, investor malfeasance. But the reality is hedge fund strategies have been used for a long, long time, very successfully for high net worth individuals. They haven't been used, obviously, in Canada on the retail side because it's only been the last couple of years that these investment options have been available. So as a result, it's just not something that the average person's been able to tap into. Now they are available. So for a $500 trade, a client can get a liquid alternative in their portfolio. Now these investments don't have the same flexibility as hedge funds, but they have a lot more tactical flexibility than a traditional mutual fund. So I'm going to talk about leverage, short selling, and then concentration. I'm not going to go through all these items on this summary page, but those are three to kind of make the point about how they could be an option for your portfolio. So if we look at the whole area of leverage, mutual funds are prohibited from borrowing money and getting that borrowed money into the market. Liquid alternatives can borrow up to 300% of the net asset value of the portfolio. So if they're managing $1 billion, they could lever up another, let's say, $3 billion. So you can see how that could be very powerful as a way of enhancing performance or sometimes even managing risk, particularly in an environment where interest rates are so low. So I'll give an example. Let's say that a money manager had very strong conviction. Now the markets have dropped. They see lots of great buying opportunities, and they want to leverage more money into the market to take advantage of what they think will be recovery. Well, then they can use this ability to lever into the market to exploit that opportunity. If we look at short selling, which has been in the news quite a bit lately, shorting the market, the broad market, shorting individual stocks is a very common way for asset managers and for the markets to identify companies that are not well managed. Now, there is sometimes a misuse or abuse of short selling, but generally speaking, it's a contract you can buy as an investor. I'm not going to get into it in detail today, but basically the contract will expire, but it gives you the ability to short an investment, short the market, which means if the market actually goes down, you're going to make money on that contract. And so it's actually a very efficient way for investors to either lever up opportunities or reduce risk. So the way you could do it to reduce risk is, let's say you thought that the broad market was really expensive. It's not really efficient for large asset managers to begin blowing out stocks, incurring trading costs and capital gains to become more conservative. What might be more appropriate would be to short different aspects of the market. So if that short selling position's a winner, if it goes in the right direction for them, they're going to make money on that short selling position. And that's a way they can defend their portfolio against losses on another component if the market goes down. So that would be one quick example. So again, it's a very powerful tool, and asset managers have been in this game for a long time, know how to exploit these opportunities very well, very efficiently. And they've got long-term models that give them guidance on how to use these strategies. And then you've got concentration. And again, with concentration, mutual funds can't hold more than 10% in one position, whereas liquid alternatives are still restricted, but they can have up to 20% in one sector or position in the portfolio. So they can double up the concentration above what a mutual fund can hold. So that's really the introduction so far. More than anything else, I wanted to just explore the topic with you. And then if you want more information, you can reach out to our office. Obviously, liquid alternatives are not something you put into your whole portfolio, but if you go back into that whole idea of cross-correlation, you can feather these kinds of holdings into your portfolio to try to achieve a greater level of investment diversification. Well, it's my hope that you found this video helpful. And again, if you haven't subscribed to our channel, make sure you do that so you don't miss future content that we are posting to this channel. As well, with the video, you'll find helpful links to our website, If you go there, you can poke around various resources we have. As well, if you have different topic areas you'd like us to cover, make sure you send us an email through our website. We'd be delighted to get your feedback there. As well, we have links to our retirement coaching page that has various free resources, as well as a video that discusses how our coaching services work. Anyway, wishing you all the best in your retirement and wealth planning journey. You take care. Bye-bye.